what to do during times when markets are so volatile and we see stock markets going down 700 points. One way to deal with it is by looking at companies that have pristine balance sheet, very strong free cash flow, that pay dividends and have a history of increasing the dividends. Dividend-paying stocks perform quite well during down markets because that dividend can be used to buy more shares, to give us some downside protection. And if we have companies that have a history of raising the dividends, that translates to a lot of benefits for shareholders. Historically, dividend-paying stocks added about 4% to the overall return of any stock appreciation, which is a lot. And the average dividend-paying stock on the S&P 500 pays about 2%. And the reason it's interesting for us to look at dividend-paying stocks is because they tend to perform well when the Federal Reserve is on hold. This is one of the chief arguments against buying dividend-paying stocks. What if the Federal Reserve is going to start raising rates? And I don't think this is the case for this year. Also, dividend-paying stocks do quite well during times of slowing earnings growth. And the earnings growth this quarter came out pretty flattish. And they do very well with companies that have, like I said, very strong free cash flow, and they have very sound strategies of capital allocation in the form of increasing their dividends and buying back shares. We should be very mindful about buying dividend-paying stocks in the utilities space and consumer staples space because these companies tend to sell at above-market multiples. They are extremely sensitive to a rise in interest rates. Nobody's talking about a rise in interest rates right now, but eventually we might have a situation where the economy, the US economy, is still growing pretty strongly. And then we will be having a discussion about what is the possibility of increase in interest rates. And these companies get hurt very quickly because of the high multiples they sell at and no growth. So if we follow that theme of dividend-paying stocks, I thought it would be quite interesting to make a comparison between what I consider two transportation companies. One transportation company is Uber. Most of the investors on the street don't like to look at Uber as a transportation company. I actually choose to look at them and try to evaluate Uber as if it is a pure transportation company because 1/4 of their sales is done in 5 major cities: New York, San Francisco, London, Los Angeles, and Sao Paulo. So for me, it is a transportation company. Having a market cap of $62 billion, if I were to compare it, say, to another transportation company, such as UPS, north of $80 billion, not that far off from Uber, then it's interesting to look at some of the differences between these two transportation companies. Just about the same market cap, but sea of change. For example, Uber is losing $1 billion every quarter, and they are on a course to lose about $4 billion in 2019. And on the other hand, UPS is actually earning $6.5 billion this year, about. There are huge barriers to entry for a company like UPS, not so much for Uber. Uber is going to face a lot of competition from a lot of robo-taxis, companies like Waymo of Google and Cruise of GM. This is a company that delivers about 21 million packages daily, that has about 123,000 vehicles in their fleet, 500 aircrafts. UPS operates in 220 countries. Not even a comparison to Uber. This is a company that generates about $75 billion in sales this year, expected. UPS is also selling at 13 times earnings. This is a company that generates this year anywhere between $3.5 to $4 billion in free cash flow, not negative free cash flow. And the expectations are that in the next few years, that cash flow can go up to about $6 billion. And if that is the case, they'll have more money to put aside for dividend-paying stocks. Their dividend already is at 3.8%. The payout ratio to maintain this dividend is about 50%. The average payout ratio on the S&P 500 today is about 35%. And this is low by comparison to historical numbers of about 38% payout ratio. UPS is expected to increase deliveries anywhere between 5 to 10% in the next few years. UPS is expected to show us growth rate in their revenues of anywhere between 4 to 6% in the next few years. They're expected to earn in 2019 $6.5 billion. And most likely they're going to start spending less on capital expenditures as a percentage of sales. Up to now, they were spending about 10% or more, and most likely that number is going to be reduced to about 7%. They automated completely their delivery system. And again, if they start spending less on capital expenditures, for us as investors is more money to pay more in dividends. Another interesting thing about UPS is that their employees are considered by many corporate lifers. When they join UPS, they stay there for their entire career. Take, for example, the CEO of UPS, David Abney, 63 years old, joined the company when he was 18 years old, working as a part-time employee, handling packages. This is just one example how people that join the company stick with it. In fact, the employees of the company own 20% of the shares. These are the voting shares, the A shares. About 164 million of the shares outstanding is owned by the employees. Shows you the commitment and the type of service people provide, knowing that they are a part of the success story of UPS. And I don't think this is the case with Uber. My point is, in times like that, we should definitely look for companies that pay dividends, that have the potential to grow their business, have a strong balance sheet, and are in markets that we expect to see tremendous growth, because remember that e-commerce, fourth industrial revolution, is taking place with good companies that can provide quick deliveries. Even Amazon is having a hard time to compete with UPS. And that takes me back to my earlier point, why there are such huge barriers to entry into a business like that, and why I think Uber will have a hard time competing with these companies going forward.
Today I'd like to talk about Facebook. We've recently heard about them a lot in the news because their co-founder, Chris Hughes, has spoken vociferously about the breakup of Facebook because they're seen as a monopoly. This is pretty interesting because there's a big book that circulates around Silicon Valley by Peter Thiel called 0 to 1, and it's about how the chief goal of every company in the world is to achieve a monopoly to a certain extent, but they're always punished, so these companies often try to not seem like a monopoly. Mark Zuckerberg, CEO of Facebook, has actually responded to this. It says that the breakup of Facebook would have little to do in the help to make privacy better handled at Facebook, that this would not be a solution that would be effective. Even besides this breakup, there are some regulations that are potentially going to be levied against Facebook. They have 3.3 to 5 billion in fines from the FTC. They have the creation of an independent oversight committee that a lot want to see in place, and a new privacy compliance position put into Facebook, and then tighter restrictions on how Facebook acquires data. We see these all coming down the pipeline, even beyond what would be a breakup of Facebook. There's many that see difficulty in this approach. Many of them are the other tech giants, because if this were to be imposed on Facebook, there's nothing to say that this wouldn't happen at Google or Apple, and so there's not many in favor of this. And as an alternative, they're more familiar with the technical inner workings of the platform. There's those asking for open operability of the Open Graph system. Okay, this is the open source framework that Facebook uses to actually push out their social data. There are some asking that the network and friends on Facebook are actually interoperable, so which would let other social networks actually compete. Because if you look at, there really isn't actually a lot of true competition for Facebook. Twitter is quite different. They're more of a microblogging site. We know Google Plus is dead. So you have Facebook there as the hegemon, and if you had the company make the Facebook friends more interoperable, then that would be an opportunity for others to compete. Facebook is doing well as a company. In terms of their daily active users, they have over 2 billion. They wrapped up Q1 2019 with $15 billion in earnings. They have total cash and marketable securities of over $40 billion, with just $10 billion in total liabilities on their balance sheet. So despite some of the negative press they're taking over this privacy issue and being broken up for being seen as too much of a monopoly, they have some excellent numbers to look at. Someone we're very interested in watching, and we'll see what the future holds for them.
With all the volatility in the market, as you can imagine, there's volatility with the Treasury yields as well. Keeping an eye on the yield curve for the past week, the 3 to 5 year Range has stayed anywhere from 2 to 3 basis points, which has been pretty consistent. And the 2 to the 10-year has done the same thing, stayed about 19 to 21 basis points. And although the 10-year did dip below 2.4 today, the spread between the 2-year and the 10-year still remains at 21 basis points.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like our content, please sign up to our YouTube channel. You can also reach us directly by calling our offices in Woodland Hills, California at 818-914-7461. The highlight of the week is that during down markets, dividend-paying stocks can provide a defensive posture against further market volatility. These dividend-paying stocks normally work well during times when the Federal Reserve is on hold and earnings growth is slowing down.